decided to lump Hong Kong and Singapore together in our discussion about city-states. And you may ask why. And there are several reasons. The first reason is many of my American clients have as their top priority going to Hong Kong and Singapore. And they think that that's the place that they should be. The second point is that Hong Kong and Singapore have a lot of similarities. They're small, Chinese-dominated populations. There is some rub-off effect in Singapore to Indonesia, Malaysia, and in Hong Kong to China. And so people tend to think that if they're in Hong Kong or Singapore, it's a good place to get mentioned or get known. But there's some things about Hong Kong and Singapore that are very similar, which I think people need to know about and to be cautious about. First of all, property prices have gone through the roof. I think there's been a global trend that big cities, whether it's Los Angeles, London, New York, Singapore, Hong Kong, and others, have experienced massive inflation in property. That's kind of a worldwide boom, probably caused by the Federal Reserve quantitative easing. And in Beijing and Shanghai now, property is so expensive and real estate is so expensive. And Hong Kong and Singapore are very similar, but Hong Kong and Singapore are the extreme levels. So it's not uncommon in those two markets for restaurants to pay anywhere from 20 to 30% sales and rent. And some fast food concepts can pay as high as 30 to 35%. So it's a very difficult place to make money. Secondarily, Hong Kong has minimum wage now. In Singapore, nobody really wants to work in the restaurant industry because the unemployment rate is so low. So you have real estate inflation and you have wage inflation. So how do restaurant chains cope with it? Well, if they can't adjust wages or real estate, they do the only thing they can do is they start cutting food quality. And then they start raising prices. So actually, the consumer in Singapore and Hong Kong now is getting lower quality food, lots of additives, lots of MSG, lots of sugar and salt to make the food taste more palatable, smaller portions, to the point where if you go to a kind of a fine dining restaurant in Hong Kong or Singapore for lunch, 2 hours later you're already starving after having spent $30 to $40. Now, what's the rub-off effect? It really depends on the concept. Mainland Chinese coming to Hong Kong are going for one purpose and one purpose only, to buy designer luxury goods. They normally will eat in the cheapest Hong Kong diners or tea houses. We call them cha cha teng in Cantonese. So they want a cheap meal, barbecue, Cantonese food. They'll spend $5 or $6 and they'll go back shopping. They're not really interested in eating Western food or Japanese food. They want Chinese food that's cheap. So the really only rub-off effect on mainland tourists in the industry and the restaurant industry would come from Chinese-style food. Companies like Crystal Jade out of Singapore, which have inexpensive dumpling noodle concepts. They have a concept called Lai Mian Xiaolongbao. Those concepts are very popular with mainland tourists. Cha Chan Teng concepts like Choi Wa in Hong Kong are very popular with mainland tourists. But if American brands, for example, or European brands think that they will go to Hong Kong, whether it's TGI Fridays or Outback or Jamie Oliver, and they think that mainland tourists will go to eat there and be influenced by it, they're wrong. Because those people, those tourists really have no interest in that kind of food. So essentially you enter Hong Kong at your peril. It's a very expensive market. The local operators in Hong Kong really have no interest in franchising unless it's very unique types of Japanese cuisines, like tempura or tonkatsu, or what the Japanese call donburi, which is protein over rice. There are groups interested in those kind of concepts, but in general, the successful groups are much less interested in Western cuisine, much less interested in franchising. So overall, Hong Kong's a tough market. Now, things that could grow are things like very high-end gift-oriented food ideas, such as Paul Hermé, which is one of the most expensive macaroon concepts from France. That kind of a concept is quite popular in Hong Kong as mainland tourists buy it as high-end gifts to bring back. But overall, the Hong Kong market is tough. It's difficult to make money. Rents continue to rise. Leases are only 3 to 5 years. Very difficult to get your money back. And operators, if they can't get their money back within 2 years, they really don't want to touch your concept. Now, that's pretty much the same in Singapore. The only difference I would say is the rub-off effect in Singapore would be with Malaysian or Indonesian customers and food service operators. So you get a little more rub-off in Singapore because an Indonesian or Malaysian tourist or food service operator may see a concept and want to bring it back to their host country. But still, the economics are very tough in Singapore, and Asian cuisine is far more popular than Western. So again, I do not find Hong Kong or Singapore, either of them, as my top 4 Asia-Pacific markets to enter if I was a global brand. I'd much prefer the Philippines, Indonesia, Vietnam, China, or India. It may be easier for overseas brands to go to Singapore and Hong Kong because potential partners speak English, but that doesn't mean that there's a lot of upside opportunity.